Hi everyone, I'm Victor, the analyst of Baybannfa. Welcome to the monthly foreign exchange analysis, bringing you the eye on the forecast for December 2021. The first currency pair we got is Australian dollar US dollar. The Australian dollar US dollar pair plugged to 0.7112 on Friday on the back of risk aversion, bouncing modestly from the level to settle in the 0.71140 price zone. The Australian dollar has been back on the foot against the greenback ever since topping at 0.7555 on October 29th, with the first hit by surprisingly high Australian inflation and the latter boosted by speculation the US Federal Reserve could soon announce further tightening on its monetary policy. On the other hand, financial markets are suffering big for the new COVID-19 variant, as health officials suspect it could evade the immune response provided by previous contagions or the vaccines. The Dow Jones Industrial Average is down roughly 800 points, while the Nasdaq Composite has shed 200 points so far, preventing Australian dollar US dollar from recovering further. As for the American dollar, the ongoing decline seems so far corrective after it reached overbought conditions against most of its major rivals. In the US, inflation hit a 30-year high, supporting the case of a tighter monetary policy in the country. The gross domestic product was upwardly revised from 2% to 2.1% in the third quarter of the year, while the Michigan Consumer Sentiment Index was confirmed at 67.4 in November, better than the preliminary estimate. The Australian dollar US dollar pair fell for the fourth consecutive week, and there are no technical signs of a nearby bottom. The weekly chart shows that the pair has broken below its 100 and 200 SMAs, both converging around 0.7200. The RSI indicator keeps heading firmly lower near oversold readings, while the momentum indicator lacks clear directional strength at around its midline. The daily charts suggest that the pair may reach lower lows in the upcoming days, as technical indicators had firmly lowered despite being in oversold levels. At the same time, the 20 SMA has accelerated south after crossing below, and also bearish 100 SMA, all of which reflects selling strength. The pair has bottomed this year at 0.7105, the immediate support level, with a break below it, exposing the 0.700 threshold. Recoveries towards 0.7200 will likely attract sellers, while a steady recovery beyond the latter could see the pair reaching the 0.7270 price zone. The forecast poll points at a near-term leg lower before a recovery finally takes place. On average, the pair is seen at 0.7130 next week and around 0.7300 in a month. Bears led the way in a weekly perspective, while bulls jumped to 78% in a monthly view and bears declined to 18%. The positive momentum eases as time goes by, as quarterly perspective has an average target of 0.7256. The overview chart shows that the weekly moving average maintains a firmly bearish slope, while the longer ones also head lower, although without the near-term momentum. Worth mentioning that in the quarterly perspective, some of the polled experts see the pair falling below the 0.700 threshold. Next pair we got is the forecast of Great Britain pound US dollar. Time for a meaningful downside correction, COVID and US GDP eyed. Pound recovery at the mercy of BOE rate hike bets. The Great Britain pound US dollar pair started the week under bearish pressure after failing to reclaim 1.3500 in the previous week. With the greenback continuing to gather strength against its major rivals on the back of rising U.S. Treasury bond yields, the pair extended its slide below 1.3300 and touched its lowest level since December 2020. Ahead of the weekend, the intense flight to safety triggered a sharp drop in yields and allowed Great Britain pound US dollar to erase a small portion of its weekly losses. The last data published by IHS Markit revealed on Tuesday that the economic activity in the UK's manufacturing and service sector continued to expand at a robust pace in early November. Despite the inspiring PMI readings, the British pound struggled to find demand. Bank of England BOE policymakers who were concerned about wage inflation feeding into persistent price pressures could see that as a welcoming development and reassess the need to hike the policy rate by 20 basis points in December. On the other hand, UK interest rate futures were last seen pricing a 55% chance of a 15 basis points BOE rate hike in December compared to a 75% probability on Thursday. British Health Secretary Sajid Javid announced on Friday that flights from 6 African countries will be banned from 12 GMT on Friday. Investors might want to stay away from the British pound if they think that the rate outlook will be affected by the new coronavirus variant. In short, Great British Pound US dollar could find it difficult to stage a convincing recovery next week, but the pair's losses are likely to be limited, opening the door for the consolidation phase in between key technical levels. The Relative Strength Index RSI indicator on the daily chart is edging slightly higher toward 40, suggesting that the bearish pressure has started to ease off. On the upside, Great British Pound US dollar faces initial resistance at 1.3400 before 1.3460. 20-day SMA Fibonacci 50% retracement of the long-term uptrend. In case the pair manages to hold above the ladder and starts using it as support, it could target 1.3500 psychological level. On the downside, strong support seems to have formed near 1.3280 2021 low Fibonacci 61.8% retracement. With the daily close below that level, sellers could eye 1.3200 psychological level as the next target. Although experts don't see Great British Pound US dollar extending its rebound in the near term, they see the pair targeting 1.3500 by Christmas. Last forecast is Euro US dollar forecast. Central banks in the denial about inflation and a new coronavirus variant shaking the FX board. Risk aversion took over financial markets at the end of the week, and against the general belief the greenback edged lower. Earlier in the week, the American dollar reached fresh 2021 highs versus shared currency, with Euro US dollar bottoming on Wednesday at 1.1185. Throughout the first half of the week, market participants were worried about stubbornly high inflation, pricing the possible countermeasures, reducing QE and hiking rates central banks may need to take. Concerns were backed by macroeconomic reports, as the preliminary estimates of November market PMIs indicated that the EU the upturn was accomplished by a marked increase in inflationary pressures during the month, with cost and selling prices rising at record rates. At the same time, the US reported the Personal Consumption Expenditures Price Index score reading soared to 4.1% year-to-year, the highest in 3 decades. Core PCE inflation is the Federal Reserve's preferred measure when it comes to taking monetary policy decisions. Nevertheless, policymakers have been utterly cautious, although the minutes of the Fed's November meeting released Wednesday showed many participants were on the view that elevated prices could become more persistent and the central bank should be prepared to taper further if needed. On the other hand, the European Central Bank monetary policy accounts showed that the ECB is in no rush to change its monetary policy. The document retweeted that net purchases under the Pandemic Emergency Purchase Program (PEPP) could be expected to come to an end by March 2022 and that monetary policy decisions need to be data-driven. Central bankers seem to be chasing inflation, and market participants fear the economic upturn resulting from policymakers doing too little, too late. The Euro-US dollar pair has trimmed its weekly losses, trading just ahead of the 1.1300 level. The weekly chart shows that the pair has completed a double top figure, falling roughly 550 pips after breaking the neckline at 1.1703. The ongoing pullback could continue up to the latter should the pair recover above the 1.1470 price zone. At this point, the weekly chart indicates that the pair may well resume its decline. It currently remains below the 23.6% retracement of the October-November slump at 1.1305. At the same time, Euro-US dollar is developing below all of its moving averages, with the 20 SMA accelerating south and poised to cross below the longer ones. Technical indicators have bounced just modestly from oversold readings without anticipating further recoveries ahead. In the daily chart, a firmly bearish 20 SMA stands at around 1.1420, a possible bullish target for the upcoming days, and road to the mentioned 1.470, a solid long-term static resistance level. Technical indicators are correcting oversold conditions but are still far below their midlines, falling short of confirming an interim bottom. The immediate support level is the 1.1200 figure, followed by the 1.1160 price zone, where the pair bottomed in the June 2020. A break below the latter should open the door for a test of the 1.1000 psychological threshold. The forecast poll suggests that Euro-US dollar could edge lower in the near term, as 55% of the polled experts are betting for lower targets. However, bulls take over of the monthly view, as over 80% of participants look for higher highs, with the pair seen on average at 1.1458. Bulls retain control in their quarterly perspective, with the pair seen holding about the 1.1400 threshold. The overview chart shows that the shorter moving average has partially lost its bearish strength, but still heads lower as most targets accumulate below the target level. The same chart shows that as time goes by, the accumulation of possible targets moves higher, with chances of recovery up to the 1.17–1.18 region. Nevertheless, the longer moving averages remain their bearish slopes. The above is the analysis of the foreign exchange market in December 2021. Thank you for watching. See you again next time, and happy holidays!